power of compounding investments long term is truly a magical thing. And in this video, I'm going to show you exactly why. We're going to look at what would happen if an investor bought a high quality dividend growth ETF at 25 years old and invested $10,000 into it. Then we're also going to compare an investor at 45 years old investing $25,000 into that same exact asset and to show you how important it is to get as much invested as fast as possible when it comes to high quality dividend growth ETFs. Now, if you consider yourself a long-term dividend growth investor, stick around because you're definitely not going to want to miss a thing. I just finished my brand new dividend investing ebook where I share exactly how I went from zero to now over 7 figures invested, and also on how I earned more than $6,000 per month in dividends. I also finished my custom dividend tracker that you can use to track your dividend income progress on an ongoing basis. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So before we go in and I show you the exact numbers and what this would look like long term for a 25-year-old investing $10,000 and a 45-year-old investing $25,000. The investment vehicle that we're going to be using for this video's sake is going to be the Schwab US Dividend Equity ETF or SCHD. And the reason I'm picking this ETF for this video is because, well, for one, SCHD is a very popular investment vehicle for those building a long-term dividend growth portfolio all the way up until retirement. But on top of that, SCHD does offer a decent starting dividend yield and has some extreme dividend growth, which definitely has the power to compound portfolios relatively quickly. Now, as a side note, you could of course use the same exact theory and use something like VIG or even DGRO. The main message that I'm trying to get through in this video and what I'm going to show you here in a second is just how powerful the power of compounding is long-term and why, even if you don't have all that much money, investing into high-quality assets like this one or SCHD or lots of the others is going to be very, very important to building wealth long-term up until retirement. All right, so now over here at the dividend calculator, we're going to be going through our first scenario, a 25-year-old investor starting with just $10,000 invested into SCHD, which currently offers around a 3.45% more or less starting dividend yield, offers around 9% annual dividend increases, and offers around a 3% annual share price increase. Now, on top of this $10,000 start, we are going to be giving both of these scenarios a $12,000 annual contribution, so more or less $1,000 more a month into SCHD, which of course pays quarterly, and dividend reinvestment is going to be turned down because for this video's sake, we're going to be looking at building a retirement vehicle, which, speaking of retirement, this investor, because in theory they're only 25 years old, they're going to have 42 years to invest because the retirement age, at least according to Google, is around 67 years old. Now the numbers are in, and again, this is as a 25-year-old investor starting off with $10,000 invested and contributing an annual contribution of $12,000 per year. So generally speaking, this is sort of a scenario that most 25-year-olds that have a full-time job and maybe have relatively low expenses could probably swing. So a $10,000 initial investment into SCHD is going to be giving you around $349 per year in dividends. But by year number 2, after those dividends are reinvested along with that $12,000, this investor would already have $22,000 plus with around $800 plus. Now for this 25-year-old investor, by the time they're 30, let's just say, they would already have around $65,000 and around $2,900 per year in dividends. Now, 10 years in, this investor would be, say, 35 years old, which again, and relatively speaking, is still pretty young, and would already have $162,000 invested and almost $10,000 per year in dividends. Now, 20 years in, when this investor turns 45 years old, they would have almost $600K invested into SCHD and over $62,000 per year in dividends. Now, depending on what their expenses are and, of course, how expensive things are in the future, at this point, in theory at least, this investor could maybe even retire and use their dividend incomes to cover, if not most of, maybe even all their bills, which is honestly pretty crazy. 30 years in, this investor started at 25, they'd be 55 years old, they'd have $2.6 million plus and over $500,000 per year in dividends, which is absolutely insane. Now, the numbers from year 30 to 42 get absolutely insane because, of course, with the power of compounding, the bigger the numbers get, the bigger the numbers get on the other side pretty much. And again, just a disclaimer, these numbers are of course all estimated. We don't know exactly what's going to happen long term with SCHD or really any ETF for that matter, but just going off of the numbers that we're going off of. So by 42 years in, if this investor started off at 25 years old and went all the way up till 67 years old, reinvested every single dividend along the way, and of course added $12,000 on top of that per year into more shares of SCHD. This investor in theory would have $43 million and $17 million plus per year in dividends, which, as you can see right here in the chart, about 30 years in, this is where the chart really starts to curl up and the numbers just really start to get insane. That once again, over time, especially with how long of a time frame this investor would have, starting off at $10,000 at just 25 years old, time is really on their side because the power of compounding loves a long time frame. So now on the other side, we're going to be talking about the 45-year-old and showing you just how different the outcome is, and just show you once again, the point of this video really is just how important it is to invest as much as possible as early as possible and let those dividends reinvest, and of course let the power of compounding do its thing. So if this investor started off with $25,000, remember this investor is 45 years old in theory, and had everything the exact same, besides of course years invested. This investor, because they're 45, only has around 22 years before they're 67 years old, which of course is the year of retirement. So the numbers are in, and year number 1, this investor is receiving much more in dividends than that of the investor that's 25 years old like we showed you. This investor is already up to almost $900 per year in dividends year 1. Year number 2, $38,000 in principal, and over $1,400 per year in dividends. Year number 5, this investor would now be 50 years old, $84,000 portfolio, and around $3,700 or $3,800 per year in dividends. Now this investor 10 years in, they would now be 55 years old, let's say. They'd have around $190K in principal and over $11,000 per year in dividends. Now scrolling all the way to the bottom, 22 years in, if this investor did every single thing the 25-year-old investor did also, reinvested all the dividends, and of course invested an extra $12,000 per year into SCHD, which again is a compounding machine. This investor unfortunately would fall much short of that than that other investor that started off when they're 25 years old. Now this older investor that started off at 45 years old, by the time retirement comes around, they would have around $862,000 and $101,000 per year in dividends. Now of course $100,000 per year in dividends is not bad whatsoever, especially considering this investor started when they were much older. But the main point that I wanted to showcase on this video is that every single year in dollar counts, especially building a foundation for a long-term portfolio. Setting those seeds and letting them grow larger and larger and giving them time to grow is definitely key if you want to see those massive numbers long term. Now, what does this mean for investors like you and I? Well, if you're watching this video and you're relatively young, then the fact that you do have time on your side, you have a lot of years up until it's time to quote unquote retire, you really need to utilize all those years and make the best of it, of course. And that's also why for me personally, I started investing in the stock market in my mid-20s and luckily had a decent amount of money to deploy due to a business liquidity event. So I was able to build a 7-figure portfolio rather quickly. And now that pretty much all my seeds are planted and I continue to reinvest around $6,000 per month in dividends, I'm hoping at least by the time I'm 40, 50, 60 years old, that I'll be able to build a portfolio that just keeps compounding and have those dividends well north of $100,000 per year. In my long-term portfolio, I have a little bit of everything, which also goes into my next big piece of advice for all investors out there, to diversify their portfolio. And although even though my long-term portfolio might be what some investors would consider to be a little bit over-diversified, I think that having all your eggs in one basket can be extremely risky, which is also why over time at least, I've been really focusing on buying into high-quality ETFs that own a basket of different stocks, because as time goes on, I'm really finding that diversification is truly king. But in the talks of getting started dividend investing, I want to hear from you guys all now down below. What age were you when you started buying your first shares of stocks or ETFs in the markets? Drop it in the comments down below. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.